React and discuss. Michael Darda is chief economist and chief market strategist at MKM Partners. Also with us is CNBC senior economics reporter Steve Liesman. Welcome to both of you. Mike, just a knee-jerk response to that. I imagine you on some level agree with Larry or no? Do you think that these pressures are going to really subside this time?
I think we can look forward to headline CPI inflation coming off the boil in the second half here. We've seen a big slide in energy prices. Commodity prices are down very sharply. Inflation expectations in the bond market have also come down. And there are signs of economic slowing. We've had a very strong labor market, obviously, but you've reported on first-time jobless claims moving up. And so I think the combination of inflation easing and growth slowing in the second half will allow the Fed to slow the pace of hikes. They're not going to stop and then reverse course and start cutting rates this year unless something totally out of the blue and catastrophic happens. But I do think they are going to slow the pace of hikes, and I think that the market is sniffing that out here.
Steve, what would you add? I mean, to hear a comment like that from Larry Summers, he's become one of the more influential hawkish voices out there. Do you think it would change the Fed's mind about possibly sticking with a 75, for instance, if we can assume that 50 is now the likeliest outcome?
Larry anchors the hawkish wing of the debate. I would point out to Larry, it's not a lot like March because it's July, and rate hikes are quite a bit higher. The Fed has embarked on quantitative tightening. As Mike said, the economy has slowed. And so I think there's a lot of differences. You've had a chance for some of the supply chain issues to ease. And I am contrary to almost the entire economics universe in believing that putting people back to work is not inflationary. I believe it's deflationary or disinflationary. And I think that one of the things that happens when we put people back to work is we solve supply chain problems. So, and I think the mistake that Larry makes with huge respect for him, because he's been, not quite a mentor, but I followed him over decades, going back to Russia. But I think overlaying old 70s styles inflation analogies over a 2022 pandemic recovery is a mistake in terms of analogy.
Here's the one, Mike, maybe you can weigh in on this because you just pointed out that after yesterday, we've tipped into negative territory on productivity for the last 8 quarters to the whole recovery. But what do you think that is going on there? I mean, how much of the story is about high wages? How much of the story is about work from home? Can the GDP data even be trusted? Should we be using income instead? I mean, these are the questions underpinning what Steve just raised about the structure of the recovery we're seeing.
Yeah, I think part of it could be the adverse supply side shocks that Steve mentioned. If those unwind, that should help. Part of it could be measurement difficulties. The productivity statistics are super volatile and notoriously challenged in terms of actually measuring underlying efficiency. So hopefully, fingers crossed, we start to see some better numbers. But this 8-quarter run with the last 2 negative readings has a dishonorable distinction of being the weakest, for any recovery so far. So hopefully those numbers improve. If some of these temporary factors start to self-resolve, that certainly would help.
And I want to hear, Steve, you have a very, it's nice, a glass half full kind of story about this.
Well, let me just say, whatever argument I have with Mike, he wins because his dog is so chill. There's no way I could do this with my dog, who needs to be on Ritalin or some other attention disorder drug. But in any event, Mike wins that argument. But I don't understand how people can be upset or concerned about productivity when we have the same number of workers doing 4% real inflation-adjusted GDP. When I look at GDP per worker in this country, it has risen from $129,000 to $163,000. There are forces that are working against stellar productivity. The idea that we're going to be onshoring some production, that's probably not as productive. The idea that we're going to be essentially doing something for security rather than for efficiency, deglobalization is not productivity. But in any event, at the moment, we have a huge well of productivity from the pandemic that we're working off because we're putting people back to work. But I am not worried about productivity right now.